Now, as you know, we've been team transitory when it comes to inflation in the US, believing that many of the upward pressures on prices would abate over time and were really a function of COVID-related supply constraints meeting stimulus-driven excess demand. While we still believe many of the elements of inflation will dissipate over time, the recent Consumer Price Index report has challenged this thesis. So, will inflation prove transitory? Let's break it down. Now, inflation in the U.S. for October, as measured by the CPI index, topped economist estimates, and it rose to a 30-year high of 6.2% year over year. Although the recent significant rise in energy prices had an outsized impact, representing almost 40% of the increase, core inflation, or CPI excluding food and energy, rose at a 4.6% annual rate, again, 30-year high and well above estimates. Now, our thesis has been that much of the upward pressure was a function of strained supply chains that would ultimately heal, and we're seeing the beginnings of that process unfold. Freight rates are falling, and logjams at U.S. ports are at least stabilizing and not deteriorating. And we anticipate also that an easing of the global semiconductor shortage will alleviate upward pressure on new and used cars. These have been significant inflation tailwinds. While we still believe that some of the COVID-related pressures will abate, it was worrisome to see in the recent CPI report that inflation has broadened out beyond those categories, and in particular to housing. That tends to be a much stickier kind of inflation. Now, we're also watching wage inflation closely, noting that employees are increasingly demanding higher compensation. Now, we can see this in the wage data, but also in the quits rate. That's the rate at which people are leaving jobs for better jobs. That continues to apply upward pressure on wages. Again, this tends to be a more durable kind of inflation. And adding to that, we anticipate a shift in demand from goods to services as we move past the Delta wave, and the services industries are where we continue to see a mismatch between labor supply and demand. It's logical to anticipate wage increases as a result. Now, we continue to follow the data closely, and for investors, so far companies have been able to pass these price increases along to customers, and we saw that in the third quarter earnings results where operating margins remained extremely healthy. The important question, though, is how and if the Federal Reserve will respond to this hot inflation data. Now, the Fed is tapering bond purchases with the intent to finish that program in mid-2022. Fed Chair Powell has been clear that the tapering would be complete before, and perhaps well before, any hike in rates. The recent data, though, may change those plans, accelerating the taper and pulling rate hikes closer in time. And the market has already priced in rate hikes for 2022, ahead of the Fed's stated schedule. The bottom line is that we expect that the Fed will follow the data and be certainly paying attention to this broadening out of inflation pressures, but will ultimately be patient until we reach full employment. Now, we're sticking with our outlook for the first rate hike to be in late 2022 at the earliest, but we're also going to be watching the mosaic of economic data carefully, and we continue to reassess that view.